Hi everyone, welcome back to my channel, and this is episode 2 of the Technical Analysis Basics course. This is typically used for signaling the strength of market moves, and the example that we're going to cover, because this is supposed to be a very short video, but it's based on real-world examples that you can use when you're looking at charts. So you may have often heard of the golden cross and the death cross. So we're going to look at Amazon today. They had a death cross in January of 2022, and since then the price has gone down more than 28%. Now, what's also interesting is the golden cross, which tends to be, some traders would say, tends to be a more powerful indicator than the death cross. However, these are still just indicators, and they should never really be used alone. Should always be used factoring in multiple time frames that we talked about in the previous episode, as well as other indicators. And always keep in mind that trading and investing and technical analysis is not a science, it is an art. So in this example, we can see that in 2015, in February, Amazon did make a golden cross and has made a huge swing to the upside ever since. If you see the orange arrow here, you can see that there was an additional 2 crosses for a potential death cross, but the price action was so volatile that it wasn't actually a trustworthy indicator of what was really going to happen. And that's why, even though you can see that in 2015, this was such a clear indicator, and anyone who got in on that signal made a huge profit. However, it's not always a perfect signal. This is just an excellent example. So now something else that's very commonly used in trading to spot the direction of the markets is something called a moving average convergence divergence indicator, or the MACD. This is the connection between 2 moving averages, and it's used to trigger buy and sell signals. Always use with other indicators and time frames, because you can have false positives. So be careful to be using one indicator or method by itself. Always cross-reference and understand the chart on multiple time frames with multiple indicators. This is just the second episode, so stay tuned for the rest. This next example comes from the S&P 500, and you can see that the buy signal, very similar to what we looked at with the golden cross and the death cross, are these 2 moving averages, and the direction that they're moving and how they cross each other and interact with each other signals the direction of the price. We can see here that the fast moving average and the slow moving average cross on an upward motion, and that is a buy signal. And then when the fast moving average goes underneath the slow moving average, we have a sell signal. And you can see that it's reflected in the price momentum, or at least the volume of trading. If you had made this trade, you would have made a 10% profit. So when the fast moving average crosses over the slow moving average, this is a buy signal. And we see that with the blue line crossing over the orange line here. And then the exit would have been signaled when that fast moving average went back underneath the slow moving average. And you can see that's the sell. So be careful, start just with play money until you're comfortable enough to use real money, because you've heard the phrase of blowing your account, haven't you? Well, it happens to everyone who gets too excited too quickly. So everyone, thank you so much for watching. This is the conclusion of the EMA and MACD video in this mini course. Next, we'll be talking about Fibonacci. And last but not least, give this video a thumbs up and follow me on Twitter at lydiascherr.e. Thanks so much.